Well, do you think Medicare is free once you hit 65? Well, not quite. There's actually a hidden surcharge that can quietly shrink your Social Security check by thousands a year. And most people are caught off guard by that. It's called IRMAA. And this video is going to break down IRMAA, what it is, who's impacted, and more importantly, how you can avoid it. Welcome into Dollars with Dennis. I'm Ben George with Dennis for Faith 401k and Money Management. Dennis, this is a good topic. I think you were just having a conversation about this recently, right?
I was, yeah. Clients asked me yesterday, how do I, if I keep working after 65, do I have to take Medicare? Do I do this? What's the pros and cons? And so we just went down this road. So it should be a good conversation for today. And it's a concern that most people need to look at.
Yeah, absolutely. The healthcare is a big piece of the puzzle, especially if you end up in a position where you are paying that added premium. So it could add up quite a bit in retirement. So we'll take you through that today. Again, if you have any questions for Dennis, you want to discuss your healthcare or any questions you might have in retirement, you can always get in touch. Just go to 401k.faith and you will see the contact information there and be able to get in touch. Everything is also in the show description as well. So what is IRMAA, Dennis? I know we've heard that acronym quite a bit. Most people probably don't even know what it stands for, but why is it there? What's its purpose?
Yeah, so people that have higher incomes get to share in the cost of Medicare a little bit more than people with lower incomes. And it is definitely an income adjusted premium for Medicare.
All right, so there's not technically a penalty, but I guess it probably does feel like that for a little bit for some people having to pay that extra money. So we got a graphic. If you're watching us on YouTube, you'll be able to see the graphic on the screen. If you're listening to us, make sure you check out the video as well to kind of see the breakdown. But take us through who's at risk here, Dennis, of paying this IRMAA charge, because this is obviously what people want to know.
Yeah, so first of all, most people, if they retire and they go on Medicare, this year the premium's $185 to start out with. If you have a married couple with an adjusted gross income of $212,000 or more, then you're going to share. You're going to have a greater cost from Medicare, and it goes up with income. So people that are married, people with dual income professionals and retirement business owners, especially if they sell a business at the end, retirees that take large RMDs or have large RMDs. So there's multiple things that can come into play for your earned income and put you into a limit where you have a higher premium. And I have a widow client that her husband owned a business and he died. And the first 2 years of Medicare, she had to pay a much higher premium because they were counting his income even though he was gone. And so they carried that for 2 years before they adjusted it down to what her income was to do that. So it can be substantial. And going from an individual from $74 up to $444 a month is a pretty big difference. So it can add up pretty quick.
Yeah, when you look at that chart, you can see the different levels there and the increases. And as you mentioned, bumps up to that first level of 74 all the way up to 443. And when you add that up for part B, that's $528 or from that amount to over $5,000 a year. So you're talking about a pretty substantial amount, and that's not even including Part D, which is also another increase there.
It is, yes. So Part D comes in and it's higher as well. So that can be an extra $164 to over an extra $1,000 for Part D. And then everybody will share in Medicare with the deductibles and copays that go along as well. So there's quite a bit of out-of-pocket expense you have. Most people will, if they're still working and have to pay the Medicare premium, they will pay it directly. If they're collecting Social Security, then it'll be deducted from Social Security. So we've seen that, especially this year, change a lot for people with the pension offset rule changes, and where they weren't getting Social Security before, and now they start getting some Social Security. So they had to pay their premiums, and now they get it deducted from Social Security. So a lot's going on. If you're concerned about that, if you're going into that situation, let us know. We can kind of help walk you through that, because everybody's situation is a little bit different. Everybody's income is different. So if you're married, you're single, if you have RMDs, if you have capital gains, you could have deferred comp coming in. There's many different factors that will affect your income in retirement that we don't think about necessarily right off the get-go.
Yeah, understanding what triggers IRMAA is a big part of that. And that's kind of what you do, right, Dennis, when you're working with someone, and why it's so difficult to kind of do this on your own, because you're trying to manage all these different income streams to really make sure that you aren't paying more than you have to in a situation like this.
Right. It's tough to do, and there's lots of questions. And sometimes we do it with Medicare directly with the client here, try to go through what their incomes are and make sure that we know what they'll get. And then there's some surprises like capital gains that you weren't expecting. And so sometimes you get hit and you don't even realize it's coming. So there's a lot to prepare for. And one way to avoid the capital gains is to try to harvest taxes as you go as much as possible, and not have a lot of build up capital gains in there. QCDs, or qualified charitable deductions, where you do your RMDs to a charity or pull money out, is today the only way you can not pay taxes on things. So it doesn't add to your income. So keeping in a lower IRMAA income is one thing, but then I don't ever want to tell anybody that they need to make less money. So if they're fortunate enough to have a higher income, just be prepared that you may be paying a good bit more for Medicare as you go into retirement. And that's something we can help you with for sure.
And Roth conversions can be helpful here too. Maybe not all at one time, but maybe early on as you're leading into retirement, to go ahead and begin taking those to maybe limit some of those taxes down the road.
Yep, for sure. Roth conversions, get that out of the way. Taking income from Roth doesn't add to your earned income. Having different sources of income in retirement and being able to pick and choose where you take money from is also. So if you know this is going to be taxable, then maybe you only take, that's where we will work with CPAs and the accountants that the clients work with, so that we can coach them on where to take the income from different sources to not go over or change their tax bracket, if you will, to get there, because that's important. And going from $74 to $400 is no fun per month. Everything else is a little bit too tight, so you want to not go there if you don't have to.
Yeah, it can add up quite a bit over time for sure. We talked about what triggers it and some of the strategies, but is there anything, I know you mentioned some Roth IRA withdrawals, but what else could you maybe pull that doesn't actually trigger IRMAA?
So the necessary things, HSA withdrawals doesn't affect IRMAA. Reverse mortgage income, which I'm not a fan of, but it's there. Life insurance proceeds, the Roth, as we said, there's things that you can take money from and not increase your earned income for that year. So planning is not just pull out a book and say, okay, here's our plan. You want to spend some time on it. You want to get with a professional that can go through a lot of the what if questions and make sure that you don't want to go into retirement not knowing what your healthcare, or have a good idea what your healthcare cost is going to be.
And you can see this sneaks up on a lot of people that aren't prepared for it, especially if maybe that Social Security check isn't as big as you thought it was going to be. This could be the reason for it. But there are some things you could do today through planning, as Dennis mentioned, to help position yourself better to maybe at least reduce that amount, or maybe altogether avoid having to pay IRMAA down the road as possible. But you have to take the steps today to make that happen. Again, get in touch with Dennis. 401k.faith. That is the website. You'll see the contact info there, plus some other good resources there to learn more if you want to as well. But if you have questions, please don't hesitate to reach out. I know this Medicare is a big piece of the overall plan, Dennis, but it's just one piece of the plan, right? All these things work together.
All work together. Medicare.gov, GOV is a great place to start. Lots of good information there. Medicare.gov, but reach out to us. We can walk through you a lot of those choices.
Very good. Well, thanks for watching this video. Hopefully this helps you understand Medicare and IRMAA a little bit more. But if you have questions, please let us know. Thanks for watching. Please subscribe. We'll see you again soon.
Thanks.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.